University of Mumbai, Mcom Sem 4, Personal Financial Planning, Question Bank Solution Part 7. We are doing question number 7. What is insurance? Explain principle of insurance. So insurance is defined as a contract which is called a policy in which an individual or organization receive financial protection and reimbursement of damages from the insurer or the insurance company. At a very basic level, it is some form of protection from any possible financial losses. The basic principle of insurance is that an entity will choose to spend small periodic amount of money against the possibility of a huge unexpected loss. Basically, all the policyholder pool their risk together. Any loss that they suffer will be paid out of their premium which they pay. Okay, so basically it is a contract between insurer and insured. The insurance company will charge some premium against whatever whether it is a life insurance or a general insurance. In general insurance, it may be a motor insurance, health insurance, home insurance. Okay, so um, this company, general insurance and insurance or life insurance, take a premium from the number of people. It is not one or two people, but lakhs of people will be covered under one company, and they give certain amount to the insurer company, insurance company, so that they can, if among this 1 lakh, this is an example that among this 1 lakh, if say there is a claim from the 5,000, 10,000, even 20,000, the premium collected from this 1 lakh people can be utilized to reimburse the losses this 5 to 10,000 people has been suffered in the current year. So this is how the insurance company works. Okay, but this business should run smoothly. There are certain principles of insurance. Okay, so insurance is the service that provide protection for certain type of risk that arise out of uncertain event. It gives individual an assurance by promising a certain sum of money in case of death or damage to personal property. Okay, so the insurance company collects some amount, okay, from the insured person against their life or the damage to their personal property. The insured need to pay a premium in return of the assurance. The following are the principle of insurance on which insurance contract are based. Okay, so let's see what is this principle of insurance contract. First is principle of almost good faith. Okay, so both the insurer and the insured should have faith in each other and in the contract signed by them. Okay, so both insurance means both the party, insurer and insured person, should be have faith in each other. For example, Rahul is a heart patient, should inform his insurance company about his health issue while buying a life insurance policy. Okay, so when you buy a life insurance policy, there is a form which you fill up, and there are certain things which you have to take. Okay, so if you have certain type of diseases, they will be mentioned. If you have so many types of disease, if you are smoking, if you are alcoholic, everything has to be mentioned. So all this information should be correctly mentioned, so that in future if any uncertainty happen, and if you are not mentioned the given the true information, and if insurance company find out it after your death, then the claim will not be settled. So whatever information is there, you have to give it. So this business or this contract between two people will run on the principle of almost good faith. Then second principle is principle of insurable interest. Okay, so person should have the insurable interest of the say the life value, or it can be object to be insured. Okay, so it should be valuable. So it implies that the insured should have some interest vested in the object being insured by him or her. Example, a business person has an insurable interest in his or her land, house and other property. Okay, so if the business person is there, he will be also, he will always have an insurable interest in his business land, his house and other type of property. Then third is the principle of indemnity. Now, what is the principle of indemnity? According to the principle of indemnity, the purpose of the insurance contract is to bring back the insured to the financial position he or she was in before the loss occurred to him or her because of a mishap. So as per the principle indemnity, the person should be living the same life before the damage happened to his life uh, once he is insured. So, okay, so they insurance company try to bring back him or her to his normal life. Example of principle of indemnity is if an individual suffer a loss of rupees 1 lakh in a fire accident, then the insurance company will accept a claim of up to rupees 1 lakh and not more. Okay, this was the principle of indemnity. Then let's see the fourth principle. Fourth principle is principle of proximity cause. This principle states that the reason for the loss or damage of the insured object should be related to the subject matter of the contract. Okay, so what is the principle of proximity? This states that the reason for the loss of a damage of an insured object should be related to the subject matter of the contract. So it should be properly mentioned in the contract that's the particular uh, thing or particular whatever has happened to certain thing is mentioned in the contract. For example, if an individual suffer a loss in a fire accident, then this should already be the part of the contract so that a person can claim the insurance amount. Okay, next principle is principle of subrogation. According to the principle of subrogation, once the compensation is paid, the right of ownership of a damaged property passed on to the insurer. The insured cannot sell the damaged property to make profit. Okay, so according to the subrogation, it's what? Once the damage is paid to the insured person, then this property, whatever damaged property is there, it will be passes to the on to the insurer. So insured cannot sell the damaged property to make profit. Example, if a person receives rupees 1 lakh for his or her damaged stock, then the ownership of the stock will be transferred to the insurer company and the person will hold no control over the stock. Next is principle of contribution. If the individual buy more than one insurance policy for the same object, then the insurer will contribute to compensate the insured for the actual amount of loss. Okay, so contribution means what? Whatever will be the value of the particular um, object, okay, or even the life, okay, that much insurance only will be given to the particular life or a particular object. And no, you can the person can buy insurance policy from a different insurance company. But now suppose if the insurance has been taken for a 3 lakh and the value of the object is of 1 lakh, so or the loss happen is of only 1 lakh, then the insurer will only get 1 lakh rupees from both the insurance company. He will not get from both the companies 1 lakh rupees. Okay, so for example, if A insure his or her house for rupees 2 lakh with the insurer B and for rupees 1 lakh with another insurer, say C, then in case of the loss of rupees 90,000, insurance B and insurance C will together pay rupees 90,000 and not more than that. So whatever value is of the object, that much only will be insurance will get from the insurance company. Then the next principle is principle of mitigation. The insurer should take care of the insured object in the same way as he should have in the absence of insurance. Okay, so once you have taken the insurance, it is not like you will behave very carelessly and you will not take care of whatever has been insured. Okay, so you have to take care of the things as if it is not insurance, because you have just insurance. That means you cannot be relaxed and you think whatever will happen in the damage will be paid by the insurance company. This attitude should not be there. The insurance should be taking care of the object in the same way as he or she should take in the absence of the insurance. Example, if a person has insured his house against fire, then he or she should take all possible measure to minimize the damage of the property in case of a fire in the same way he or she would have done in the absence of the insurance. Okay, so this was the principle of insurance. In all, we have 7 principles. Okay, so we can conclude that in simple word, insurance is a contract, a legal agreement between two parties, that is the individual named insured and the insurance company called insurer. In this agreement, the insurer promised to help with the losses of the insured on the happening contingents. The insured, on the other hand, pays a premium in return of the promise made by the insurer. The contract of insurance between an insurer and insurer is based on certain principles. Okay, so this were your answer for question number 7. For next answer, please prefer subscribing and click on notification bell icon and for the next part. Thank you.